Good afternoon and welcome to the 2020 Economic Recession and Preparation Channel. I'm your host, Tony. Thank you for joining me today on this August 19th, 2020. Dow Jones closed again a little bit slightly down, 54 points on the hour, and the Fed continues to issue guidance, lower guidance for the remainder of the year. According today by MarketWatch.com, the Fed staff lowers forecast for economic growth over the rest of the year, according to the FOMC minutes today that they have. That's the Federal Open Market Committee minutes. Federal Reserve Chair Jerome Powell testified that the spread of the sickness virus since mid-June is dampening the recovery efforts. The Federal Reserve staff told central bank officials that they are lowering their forecast for economic growth over the second half of the year. At the latest meeting, it is reported that the rate of recovery in gross domestic product and the pace of declines in the unemployment rate to be somewhat less robust than the previous forecast. Federal Reserve Bank officials stressed in their policy statement released after July and August's meeting that the path of the economy would depend significantly on the course of the sickness pandemic, which we all know is not getting any better, as states scramble to try to find additional streams of revenue. Cities scramble to find additional streams of revenue before all decay breaks loose. They decided to keep the interest rates at zero and maintain monthly purchases of $120 billion of U.S. Treasuries and mortgage-backed securities. The Fed Chairman Jerome Powell insisted that the central bank isn't even thinking about raising rates. So that tells you right there that we're going to be at 0% interest rates, because if we even raise interest rates by a quarter percentage or a percentage point, it's all over for this economy. Dominoes, because the economy is 2/3 based on consumer spending. If interest rates rise, that means people will not be able to take out loans on houses, cars, signature loans. Any of that will go to zero. Banks will collapse because interest rates will be rising. If interest rates were allowed to rise to the true part where it should be at, we should be well over 8% or 10% by now. But because the Federal Reserve has been lowering interest rates for the last, basically since 2008, we're in this predicament where they cannot raise rates because the economy will go into a severe depression, which is coming anyway. It's inevitable, as we know, as I've been sharing with you, but they're going to get at least this by some more time. Several Fed officials said that the additional monetary easing steps could be required to strengthen the economy. Key word there is more quantitative easing, more stimulus checks. Unfortunately, you can't write a check that you know what happens when you write a check that you don't have the money in the bank to actually cash it. It becomes bounces or insufficient funds. So get ready for America to write you a check, cities, states, counties, and individual Americans, that's going to be bounced. It's going to have insufficient funds, because we all know that any sovereign government cannot keep printing money that's not backed by anything. It's not backed by gold anymore, since Nixon took us off the Bretton Woods standard back in the 1970s. And so we're based on a fiat currency system that's backed on nothing but pure faith and confidence in the note that you can actually exchange it for some kind of value. But once that consumer confidence dies, which it is now, and as a matter of fact, the consumer confidence is dying around the world for U.S. dollars. The U.S. dollar index is closed below $93 for the first time since 2003, and it's continuing its slide. So that tells you that not only is the world trying to get off the dollars, but the U.S. dollars days are numbered, and the Federal Reserve Bank knows it, and they have no other choice but to continue to print this dollar into infinity, into oblivion. In light of these concerns, the Federal Open Market Committee is trying to keep the inflation rate at the Fed's target of 2%. We keep hearing that they're keeping the Fed inflation rate at 2%, supposedly. However, what's going to happen is we're going to have massive inflation in this economy, massive hyperinflation on food and consumer goods, but we're going to have massive deflation on the big assets like housing, commercial real estate in these cities. But the problem is no one's going to actually have money to repair and to fix up and to buy these houses and to flip these houses like they did in the past in 2008 crisis, before 2008 crisis and all that. So that's going to leave us with destitute cities, uh, largely packed suburb compounds of high rises and apartments packed with people who have been houses have been foreclosed on because the housing crisis hasn't started yet. It is coming. The housing crisis will begin in October and it will accelerate into next year where we're going to see massive foreclosures, massive bankruptcies. As a matter of fact, according to the New York Times, a flood of bankruptcies is coming and we could see massive bankruptcies to the tune of more than $200 million companies filing for bankruptcy. Retailers, airlines, restaurants, oil producers, fitness centers, everything. There are more than 180 companies that have already filed for bankruptcy in the United States this year, partly because of the sickness shutdown. Many big iconic names, Hertz, Brooks Brothers, Steinmart, and the list continues. Some of the bigger companies, New York and company, retail companies, some of the other companies that filed for bankruptcy, United Cannabis, Raven Air, Alpha Entertainment, Frontier Communications, Chesapeake Energy Company, Essentia Retail, Latam Airlines, that's a Brazilian airlines, they filed for bankruptcy. And this is just the tip of the iceberg. Bankruptcy judges around the country here have reported an increase in bankruptcy filings, and consumer bankruptcy filings are going to be on the increase once the housing market implodes starting in October. It is coming. Get prepared. In addition to this, we also have to look out for, not only do we have to look out for hyperinflation, but we also have to be concerned about the slow trade war, the Chinese trade war in terms of technology. We're not exporting that much goods. We're definitely not producing anything over here but debt in the United States. And because of which it is possible that the things that we know and love, such as the postal service and other things, could be going by the wayside, even though they were losing money before, and that's no surprise. But still, things that we have come to depend on could be taken away ever so slightly and file bankruptcy because they're not going to have the money. Walmart, as I told you before, they said consumer spending dropped as stimulus checks ran out. And the truth is, we may not get a second stimulus check. And that's why I'm so adamant about being prepared now, because a lot of us didn't get the first stimulus check. But now they're saying that, Congress is saying that we're not going to get the second stimulus check because they don't have the money. They don't have the money. Remember, we've already spent $9 trillion on stimulus that didn't work. And the second stimulus bill is reported to be $3 trillion package, but we just don't have the money to do that. America's broke. We cannot bail out every industry and bail out the individual consumer and still be a functioning economy. It just doesn't work that way in the real world. So the good news is, I guess, that the CNBC is reporting that retail sales rose 1.2% in July. Wow, I guess that's a lot of sales. But they exclude car sales, which have been absolutely dismal the last 8 months. They say that electronics and appliances led gains, while bars and restaurants were also up. Wait a minute. So I thought bars and restaurants were closed the last few months. Somebody help me out on that. But they're telling us on CNBC.com today that Americans are buying stuff, that retail sales are on the rise. I beg to differ on that. Consumer spending is pulling back on discretion. Consumer spending is pulling back on these luxury items. Consumer spending is only buying things that they absolutely need, like essential food, supplies, food, water, clothes for their kids, educational supplies, gold, silver, crypto. These are things that are going to matter. Don't be fooled by what the media is trying to spin on you by saying that the consumer is out shopping at these places. When I go to the malls, not malls, but when I go to these outlet places, when I go to Target or the outlet places or Walmart or Sam's and Costco, most people in their carts have essential items. They don't have things in there that are luxury items. When my friends report to me that they're in cities like Las Vegas and LA and San Francisco and Chicago and New York, they're leaving. They're reporting ghost towns in Times Square. They are reporting ghost towns in these luxury condos area. The vacancy rates are high, as I've stated before, in these luxury condos and the townhouses and apartments because people are leaving for a cheaper city, a cheaper cost of living before things really get bad. So I suggest you do the same. I suggest you continue to cut costs because this thing is only going to get worse. As a matter of fact, 10 states were approved today to offer extra $300 weekly unemployment benefits, mostly in the West. And South Dakota was the only state so far to decline the assistance promoted by the president. So, but the unemployment assistance only lasts 3 weeks in some states. So, first come, first serve. After 3 weeks, you're back to square one again. I'm sorry for some of these states like Arizona, Colorado, Idaho, Iowa, Louisiana, Missouri, Montana, New Mexico, Oklahoma, and Utah. They're going to offer a $300 supplement to jobless benefits, which, so that's down from the $600 a week subsidy that was created earlier during this sickness. What are you going to do when that runs out in 3 weeks? What are families going to do? I'll tell you what they're going to do. They're going to move in together. They're going to be downsizing and to try to survive this because it's clear that this sickness pandemic is going to be more than a 1 year or 2 year event. So get prepared now. This is Tony signing off. Be safe, and I'll talk to you very soon.